2024 was the year of big elections. Almost half of the global population went to the polls, with elections taking place in about 70 countries. It was a bad year for incumbents. Since the COVID pandemic, 40 incumbents have been removed from office across Western democracies. In India, the NDA managed to stay in power, but with a reduced majority. Over the next 30 minutes, we take a look back at the big events that shaped India and the economy. You're watching Rewind 2024, and I'm Shireen Bhan. Let's start with Indian finance sector, where it was a year of heightened regulatory scrutiny. From fintech heavyweights to traditional banks and microfinance institutions, the Reserve Bank of India took action against a series of lenders and financial entities, signalling a firm stance on regulatory compliance. CNBC TV 18's Ritu Singh has the highlights of what has been the year of the big regulatory crackdown. Take a look.
2024 was a year of reckoning for the financial sector. The Reserve Bank of India took unprecedented action against various financial entities, signaling a shift towards stricter compliance and consumer safety, and driving home the message that abiding with regulations is non-negotiable. The ball was set rolling early in the year with action against Paytm Payments Bank. The RBI barred the bank from onboarding new customers or accepting any deposits, effectively shutting down the payment bank's business. It based this action on repeated non-compliance by the bank with KYC norms and governance deficiencies. But it wasn't Paytm Payment Bank's first brush with the RBI. However, this time, the central bank had run out of patience.
Such restrictions which we impose are always proportionate to the gravity of the situation.
In March, two firms, IIFL Finance and JM Financial, faced business restrictions. IIFL, a key player in gold loans, was restricted from issuing new loans because of violations in gold valuation and loan-to-value ratios. For JM Financial, the offence was governance lapses in financing IPOs and bond subscriptions. In April, Kotak Mahindra Bank was ordered to halt onboarding new customers through its online channels and suspend new credit card issuance because of weak IT systems. And the crackdown extended to microfinance as well as new age lenders. In October, RBI barred 4 non-banks, DMI Finance, Ashirvad Microfinance, Navi Finserv and Arohan Financial Services, from sanctioning and dispersing new loans, citing excessive pricing practices and non-compliance with regulatory guidelines.
We found a number of NBFCs charging exorbitant interest rates.
Right.
Interest rates going up to 40%, going up to 45%. Now, and who is the borrower? The borrower is he is a man of small means.
Right.
And these are not well-off sections of society.
Restrictions on one of the NBFCs, Navi Finserv, were lifted in a little over a month, on IIFL Finance in 6 months, while those on JM Financial products were in place for 7 months. The others, however, are yet to free themselves of regulatory embargoes. So why this sweeping regulatory action?
The Reserve Bank has taken up this as one of its focus areas to create awareness as well as to ensure adherence to good corporate governance practices.
The RBI's tough stance has been met with praise and criticism. Some quarters allege it is being overly punitive, especially towards fintechs. For instance, soon after the action against Paytm Payment Bank, a dozen startups penned a letter to the government arguing that such measures could stifle innovation and hurt the broader fintech ecosystem. RBI says the numbers don't support this argument.
Out of over 150 banks, over 9,000 non-banking financial companies, about 1,500 UCBs, and various other entities that we supervise, stringent actions have been taken only in a handful of cases.
RBI believes these actions will serve a dual purpose. One, it's a signal that the cost of non-compliance will be too high to ignore. And two, it promises consumers greater transparency and protection. For financial entities, this is a wake-up call they cannot afford to ignore. What is becoming increasingly evident is that this is a new, stricter, no-nonsense RBI that expects and demands compliance with its rules and regulations. And while it is willing to give financial entities time to get their house in order, its patience is not endless. In Bengaluru, Ritu Singh.
From finance to the steel industry, which lost some sheen in 2024. Chinese steel makers had built up inventory due to the pandemic and flooded the market with steel products, which kept prices subdued across the world. Now, this forced Indian steel makers to ask the government for safeguards, including a hike in the import duty on Chinese steel. Nigel D'Souza is here with a recap of the year that was for India's steel industry and what could be in store in 2025.
Well, the problem of 2024 for the global steel industry has been that Chinese steel demand has been weak, which has resulted in higher Chinese steel exports. Well, let's explain this to you in further detail. India's steel demand has been rising at 10% over the last 4 years. But in the same period, Chinese steel demand is down by 13%. Now, India is the second largest steel producer and will remain an important growth driver in the world. The issue is China has slowed down, which has resulted in Chinese prices slipping to COVID lows, which in turn has pressurized global steel prices. The Chinese housing market has remained weak, with prices of newly built commercial and residential buildings slipping all the way since mid-2023. This has impacted steel demand, thereby leading to rising iron ore inventory at Chinese ports, which is currently way higher than the average inventory levels. The pain point is that Chinese monthly exports have been rising because domestic demand out there has faltered. And for the first time since 2016, Chinese steel exports will clock more than 100 million tons. It's also on course to challenge the previous all-time highs. Well, the Indian steel industry, they are up in arms. Mr. Sajjan Jindal has made a solid pitch. He wants some protection for the domestic ferrous industry, because Chinese steelmakers, they have an unfair advantage and part of their exports are trickling into India. Well, the Steel Ministry has recently proposed to the Finance Ministry to impose 25% safeguard duty on steel imports, as India has now turned a net importer from being a net exporter in the previous year. Well, Nuvama has said the imposition of some safeguard duty, along with the onset of a seasonally good quarter, could give the steel producers some elbow room to go ahead and increase prices by around 2,000 rupees per ton, as domestic prices are at a bit of a discount in comparison to the landed cost of imports. But they also highlight that factors like anti-dumping investigation in Europe and aggressive exports by China is eating into India's exports, which is more concerning than the elevated imports that we're seeing. We'll have to stay tuned to see the government's action with regard to these rising imports, but things could get better for the domestic steel industry from here on, because Chinese steel prices could have bottomed out. Their exports as well could slow down. Additionally, domestic steel makers, well, they've chalked out their capacity addition plans with focus on value addition and cost efficiencies, which could support volume growth and probable expansion of unit profitability. Well, the steel industry hopes to get its sheen back in 2025.
From the steel industry to energy and nuclear energy in particular, as the world looks to move away from fossil fuels, nuclear power is starting to take center stage. 2024 saw the world's first nuclear energy summit take place in Brussels. Nuclear power generation is on track to reach a new record high by 2025. Sonal Bhutra is here to explain how the world is going nuclear.
At the COP28 summit last year, more than 20 countries signed a joint declaration to triple nuclear power capacity by 2050. According to an IEA report, nuclear power generation is on track to reach a new record high by 2025. And according to International Atomic Energy Agency, or IAEA, world nuclear capacity will increase by 2.5 times the current capacity by 2050. But first, let's talk about some stats. At the end of 2023, 413 nuclear power reactors were operational with a global capacity of 371.5 gigawatt, and as per IAEA, this number will reach the 950 gigawatt mark by 2050. Just to clear the basics as well now, nuclear energy can be created either by nuclear fission, which is division of a heavy atom into two light atoms, and with fusion, the phenomenon is reversed. Two light atoms combine to form a larger atom. Energy is created in these processes. But what is driving the big surge in demand for nuclear energy? The reason is the big clean energy push. Nuclear energy is considered as clean technology as it produces nearly zero carbon dioxide and other greenhouse gas emissions. Nuclear power stations use a minuscule amount of fuel to generate the same amount of electricity that a coal or gas power station would. For example, 1 kg of uranium contains the same amount of energy as 2.7 million kg of coal. So nuclear fuel is considered to be a reliable source of energy for decades to come. Second, nuclear energy produces more electricity on less land than any other clean source. As per energy.gov, the website for US Energy Department, a typical 1000 megawatt nuclear facility in the United States needs a little more than 1 square mile to operate, whereas wind farm requires 360 times more land area. And third, nuclear energy produces minimal waste so that it works in their favor. But are enough investments made in this segment? Because we are mostly hearing investments around renewable energy, right? So, from 2017 to 2023, every year, $50 billion of investments have been made in this segment, and IAEA says it should increase to $125 billion annually if capacity addition plans are to be met globally. IEA adds that in 2024, this number would be $80 billion. And currently, nuclear power share in clean energy investments is around 9%. But there are some challenges around nuclear energy. Of course, it requires large investments, so large front-up costs are an issue. The lead time to set up a plant and commercialize it is longer than alternative sources such as natural gas. And of course, there are massive concerns around nuclear waste and nuclear weapons because of the harmful radiations. But which countries are investing in nuclear energy? Well, nuclear energy is around 10% of world's energy consumption, and 15 countries only account for 91% of global nuclear power. US is the highest at 31%, followed by China at 13.5%. This is in terms of production. Then you have France, Russia and Germany, which are some of the big names. And which are the countries that rely the most on nuclear energy? This is in order of reliance. France, Slovakia, Ukraine, Hungary, Bulgaria, Belgium, Slovenia, Armenia, US, China, Canada, there's UK, Germany as well, as per IAEA. But then where does India stand in this? Well, the government recently indicated that they will increase nuclear power generation by 70% in the next 5 years, from the current 7.48 gigawatts to around 13 gigawatts, which is by 2029. And there are 21 new reactors under various stages of implementation to reach that target as well. So there are interesting changes in the clean energy space, but this one comes with its own caveats.
Well, time for us to head into a short break, but when we return, a special report on the quick commerce boom. That and more on Rewind 2024.